Hey everyone, welcome to another episode of Adam Talks, a podcast that takes an alternative look at retirement. This is Adam Bergman, founder and CEO of IRA Financial. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to an emergency episode of Adam Talks. I'm Adam Bergman, tax attorney, founder of IRA Financial. So I wanted to jump on a podcast real quick, kind of an emergency podcast, to discuss President Biden's proposal to hike the capital gains tax rate from a maximum 20% to 39.6%, plus a 3.8% tax on net investment income. Now, this will only apply to those individuals earning more than $1 million in a year. Now, the question is, what does earnings mean? Is it ordinary income? Is it adjusted gross income, which could include long-term capital gains? It's unclear. We're going to have to wait for more details to emerge as part of this proposal. But this is monumental. This could essentially move our capital gains tax rate to the highest it's been since the late 70s and make it one of the highest really in the developing world, almost double what Canada's is. Now, if you have the privilege, I should say, of living in New York, which I used to live in and I still have an apartment in, or Los Angeles or California, or you're going to potentially, if you're wealthy and earn over $1 million of earnings, whatever that means, you potentially could pay over 50% in capital gains tax. Well, congratulations. Crazy stuff. So number one, we need to know what earnings is defined as. Okay, and I've been doing some research. I spoke to a number of CPAs that I work closely with, and I've got mixed messages. Some said, well, it's AGI, so if it's adjusted gross income, then let's say you earn $250,000 as a lawyer, but you just sold an apartment that you were holding as an investment vehicle or investment asset, and you have $900,000 of capital gains. Now with your $250,000 of salary, you have an AGI, let's say of over $1 million. Is that asset, that capital asset that you used to pay 20% tax on, now taxed at 40% or even higher if you live in New York or California? I don't know. Is it just earned income? Is the IRS going to look at just your ordinary income when it comes to this $1 million threshold, or is it going to look at AGI? I would think they're going to look at AGI because that's kind of what they look at now to determine your capital gains tax rate. Higher capital gains, from a long-term capital gains standpoint, it's taxed at a lower rate, but it's still considered part of AGI. AGI is adjusted gross income, and it can actually determine, for example, if you can make Roth IRA contributions or not. So your AGI is super important for determining whether you are privy to certain retirement options or other benefits. So I would think that this Biden proposal, that $1 million would be a AGI number and not just a regular ordinary income number, because then people can play around with it, right? You can say, okay, I'm going to take a $700,000-$800,000 salary and I'll get more compensation by way of options, or I'll sell stock in my company. I'll have my company buy stock back for me, generate more capital gains and ordinary income. I don't know. I think there'll be a lot of playing. Another wrinkle to this is that as part of this proposal, the Biden administration said that they will also do away with step up in basis on death. So I guess the idea is, hey, if you don't pay estate tax, generally you get a step up in basis in death. No matter what. So if you had an asset, let's say your dad had an asset, your mom had an asset, they paid $1,000 for it, now it's worth $1 million. They die, you take the basis of $1 million. They want to do away with that and have a carryover basis of the $100,000. This is game-changing stuff. This is basically a bomb that's gone off, and now we're gonna have to deal with it. The big winner. Sorry to say, it's going to be the Roth IRA. And I've been preaching this for a while, telling people, hey, get your ducks in order. It's going to happen. Biden has told us for a year plus since the campaign. Hey, I'm going to raise your taxes. Okay. And I'm going to raise your capital gains taxes. So I've been telling people, think about getting more money in a Roth. Why is a Roth important? Because so long as you're 59 and a half and the Roth's been open at least 5 years, you pay no tax. Zero. Zip. No tax on all your gains. So forget about ordinary income or short-term capital gains or long-term capital gains or holding periods or basis. Zero, zero, zero tax. So in a capital gains tax environment where the wealthy are paying over 40 to 50% in tax on their assets, that's a game changer. Now, just to back up, capital gains is different than ordinary income. Ordinary income you pay when you earn compensation for services like a W-2, 1099. Capital gains is when you sell a capital asset like stocks, real estate, even cryptos. Those are deemed capital assets. As of today, capital assets are taxed at a lower income tax rate than ordinary income or compensation. The highest compensation rate for ordinary income is 37%. The highest capital gains tax rate, if you make over $450,000 or so of income, is 23.8% because there's a Obamacare investment tax. Okay. Biden wants to move that 23.8 to essentially 43.8 plus you'll pay another 10% or so if you live in New York or California. So over 50% in those two states. But for everyone else, if you earn more than $1 million of income, that capital gains could be now increased almost twice as much. The big key to all this is what is the $1 million threshold made out of? Is it just ordinary income? Or does the capital gains that you generate during that year count as part of that 1 million like it does now for AGI? I'm not sure. We'll need more information to know more. So it's going to be something that we'll have to learn more of. This is too important for so many people. Because again, it may not just be the wealthy. If your long-term capital gains is taxed as part of this $1 million, then it's going to bring in a lot of middle-class people that, hey, I just sold my business. I just sold a home that I use for investment purpose. I just sold a lot of stock. Hey, I bought Bitcoin at 12,000. Now it's at 50,000. Hey, I bought Tesla, 4 years ago. Now I want to sell it. Guess what? You may now be part of this $1 million threshold and now have to pay 50% or at least 40% tax on your Tesla or your Bitcoin or your apartment or your Airbnb unit that you bought as an investment. No one knows. I can tell you that there'll be a lot of selling this year. The market will fluctuate, right? If you, especially towards the end of the year, if this thing is going to pass, it's going to pass for next year for 2022. And I think it's probably, 60-40 it passes. There may be some modifications, but I think this is going to pass. The Dems could control the Senate. They control the House. It's a very slim majority. We'll see. Senator Manchin of West Virginia could play an important role. From what I hear from the lobbyists I work with, 60-40, this thing passes where the capital gains tax rate will skyrocket high for the wealthy. But again, that 1 million threshold may not just bring in the Bezos and the Buffetts, right? It can bring in the Joneses and the Smiths and the Wilsons and the Schwartzes, right? Everyone could be part of this if you sell just some stock or some cryptos or some real estate that you've been holding, or if your parents have died and they're leaving you appreciated assets, you're going to deal with a carryover basis, not a step up, and you may pay that $1 million, you may hit that $1 million threshold, I should say, and be subject to that 40% tax on some of your assets that your parents have left you, assuming you're not paying estate tax on it. So a lot of moving parts. It's a nuclear bomb. I mean, this thing is major. The Roth IRA is going to win. It's the best legal tax shelter out there. Start thinking about getting cash in a Roth. How do you get money in a Roth? 3 ways. Contributions, $6,000 or $7,000 if you're over 50. However, if you make more than $208,000, you married, filed jointly, you cannot make Roth IRA contributions. However, you can do a backdoor Roth IRA, which essentially allows you to make an after-tax IRA contribution and then just convert it to Roth. Just be aware that if you have other IRA assets out there, the amount you contribute to Roth as part of that backdoor strategy may not all be able to be converted to Roth because of a pro rata formula. Number two, rollovers, right? If you have another Roth IRA or you have a Roth 401k and you're leaving your job or over 59 and a half in a 401k, you can move those assets tax-free to a Roth IRA. And the third is conversion, which I think that is going to be a monster word this year. People are going to try to convert their assets from pre-tax to Roth, especially if the markets drop. The crypto markets, been a little volatile lately. If real estate prices start dropping, if stocks start dropping, you're going to see people, especially this year, look to start moving some assets from pre-tax to Roth. You need to pay tax on the fair market value of your conversion, but you may want to do it this year when the tax rates are a bit lower and you're not dealing with that $1 million threshold that could skyrocket your capital gains, your long-term capital gains tax rate to over 40%. Now, when I say capital gains, again, it's capital assets and it's assets held longer than 12 months. If you hold a capital asset less than 12 months, you're going to pay ordinary income tax rates anyways. So that's not relevant. But for all those hedge funds, private equity, venture capitals that get their carried interest and that's very, very, very attractive capital gains tax rate, this is a game changer. This can push that 20 to 40%. It's going to be essentially worse than ordinary income tax, or at least the same. Real estate investors, right, who love that capital gains tax on the sale of the asset, that may go away. All our day traders loving Robinhood, holding stocks longer than 12 months, crypto savvy instead of had cryptos for 4, 5, 6 years, no more 20% gains or 15% tax on those gains. If you earn less than 450K or so, you may be looking at almost 40% tax and 50% if you live in California or New York. So this is a lot of, it's a bomb. And I had to do an emerging pod because I just wanted to kind of get this off my chest. More to come, obviously. This is going to be a big boom for the self-directed retirement industry. I feel kind of bad saying it because not sure it's going to be great for the economy to have capital gains tax rates at 40%. Yeah, I'm sure the Treasury will have a lot more money to spend on I guess, important things, but that's a big, big, big jump, right? From 23, let's say, for multimillionaires who have tremendous amounts of capital gains to almost 40% or 50% if you live in New York or California. So that's a big, big, big increase immediately. So things will change. There'll be tax planning, obviously. There'll be some workarounds. The Roth will be a big part of it. Life insurance will be a big part of it. Finding ways to get money into sheltered vehicles where you don't pay this high capital gains tax rate will be super important. But again, for the average person that makes 100, 200, 300, 400 grand a year, has a normal middle upper class job, lawyer, accountant, doctor, IT, engineer, whatever, and they have that year where they sell their consulting business, they sell their business, they sell their asset, they hit it big with stocks or cryptos. And now, if this $1 million threshold is based off AGI, now you're over that $1 million threshold when you combine your capital gains assets with your ordinary income for that year. Now, that asset, that business that you've had for 25 years or that stock you've had for 5, 10 years, or even 13 months, now you got to pay almost 40%, if not 50% tax on it. Wow. Are you going to sell it? You're just going to hold it till someone else comes to the White House in 3 years? We'll see, right? You probably see a lot of people trying to sell their business this year. You're going to see a lot of conversions, a lot of plays into Roth. Life insurance will be big. And then you may be in a situation in the next 2-3 years where people are going to say, I'm not selling any assets. That can drive real estate prices high. That can drive the stock market high. There'll be a lot of demand, not a lot of supply. People are going to say, I'm waiting until the next president comes in and let's see what they do, he or she does, because it can't be worse than 40 or 50% capital gains tax. There's no way. And if a Republican comes in, they're going to do away with it, especially if they can control the House and Senate. So a lot to be determined. I just wanted to jump in on this because it's too important not to say anything. It impacts almost all of us, not all of us, but a good chunk, not just the Jeff Bezos, right? It's more than that. Because again, based off that example, you can make 150 grand a year and then have that one asset that's basically your big savings, your one asset that you're focused and counting on to really provide you flexibility and wealth in your later years. And now you got to sell that and pay 40, 50% tax on it instead of 20. It's like, wow, that's a game changer, right? 30% extra tax on 500 grand, 600 grand, that's real money. So what do? Yeah, you're probably going to hold it, right? You're just not going to sell it. Figure out a way, refinance it, get some cash out, right? A lot of people are just going to strip the assets of the value, just like private equity firms do. Just leverage the heck out of these assets, pull tax-free cash out instead of sell it. That's what I would do. You have an asset with $800,000 in equity in it. You don't want to sell it. You need cash. Go get a mortgage, refinance it. Pull 500-600 grand out. It's a cheap way to do it, not pay any capital gains tax. So there'll be ways around this. Trust me. Anytime you move from 20 to 40%, there's too many smart tax attorneys, CPAs out there that are not going to have a plan. And the obvious ones are Roth IRA, life insurance, and just grabbing more leverage. Leverage up those assets and strip all the cash out. And who cares about capital gains? You'll zero out the capital gains anyways. You'll have tax-free cash from the refinancing of that asset. So there'll be workarounds, but the retirement system is going to be key. Selfishly, it's going to be good for our industry, but it could be good for all of us because it could force us to save more. You'll get more deductions. If you're doing Roth, you'll get more assets in a tax-free account, which will shelter you from this increased tax on capital gains assets. So we'll see when this passes. Again, this is not the law. It's a proposal. It's for $1 million, whatever that means. This is ordinary income or adjusted gross income. We shall see. More to come, but just wanted to jump in on this bomb of a proposal by the Biden camp. So that's it. Hope I didn't scare anyone. We'll be okay. We'll survive this. There'll be workarounds. I promise. And if you're listening, you're probably into the retirement system. You're probably part of the self-directed retirement nation. So I actually spoke to a client yesterday who's got a lot of money in a Roth IRA, and he's like, kind of feel bad. Kind of been planning on this. Like when I say a lot, I mean like tens and tens of millions of dollars. He's like, my friends are in New York and they're freaking out because they're hedge fund venture capital guys, and their carry interest is now going to be taxed with 40%, and they're freaking, and I kind of feel bad because I'm going to have no tax. I have lots of money in a Roth, and now I just basically increased the value of that by 40 or 50% because I'm not going to pay any tax on those gains. So anyways, just wanted to jump in on this bomb of an announcement by Biden on capital gains. Again, thanks for listening. Thanks for watching. If you're doing on YouTube, subscribe. More to come. I'll be following this very closely because it impacts many of us individually, and also it's important for retirement tax planning. So take care, be well, and talk to everyone again shortly.